Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Whether you're a business owner or not, let's just play an imagination game for a second. Let's imagine here that we own a restaurant. Let's say we ran a restaurant business. If you guys ran a restaurant, again, imagine, close your eyes, think about in your town, maybe in a big city, where would you want it to be? What kind of food would you serve? What would you want the vibe of the restaurant to be? Would it be quicker food, late night dining? What would you guys want to do? Think about that for a second. And if you did own this restaurant that you're picturing in your head now, when you guys went out to eat with your friends and family on a Friday night, late, weekend, Sunday, and you want to bring your family and closest friends somewhere to eat, would you take them to your restaurant or somebody else's? All day long, you would take them to your restaurant, right? You wouldn't take them to somebody else's. That wouldn't make any sense. What about if you ran a salon or a barber shop? Would you guys go and get your hair cut at your salon, your barber shop, or somebody else's, maybe your competitors down the street? Definitely not. You'd go to your restaurant. What about a gym? If you guys owned a gym, would you guys ever go and work out at your gym or somebody else's? Have you guys ever been to the gym and seen the gym owner not working out there or not walking around helping out? Definitely not. Of course, the gym owner goes to his gym or her gym only. And here's the last one, guys. If there was a bank that you owned, you had a bank, would you make deposits in your bank or somebody else's bank? Bank of America, Wells Fargo, JP Morgan, Wall Street, right? Would you rather make deposits from your bank or somebody else's? If you needed to get a loan for a car, a home, a rental, would you go get that loan from your bank or somebody else's bank? Again, of course, you would go to your bank. And if you borrowed money from your bank, would you pay your bank back with principal and interest? Of course you would, because you wouldn't steal from your bank. So today, I want to talk with you guys about is how you can become your own bank, how you can take back the control of the banking function in your life. Guys, this is a 200-year-old strategy. It's been around a very long time, and it's been used by the wealthiest families in history to not just eliminate taxes, build their wealth, but to pass down a legacy. And I guarantee you, people who have done this strategy are people you know, people like the Rothschilds. Anyone know who the Rothschilds are? I'm sure you do. What about the Rockefellers? You guys know Mr. John Rockefeller? The Rockefeller families? What about Ray Kroc? Do you guys know what business Ray Kroc started? What business he opened? It's one of the biggest companies out there, McDonald's. And guess what business McDonald's is in? They're not in the business of flipping burgers. They're in the business of real estate. What about, and you know what, how did he get into that business? Through this strategy. Walt Disney, when he was broke in the Great Depression, was trying to start his business. Guess how he started it? from this strategy. And more recently, if you guys know Mr. Jim Harbaugh, he was the football head coach at Michigan. He's now the head coach of the Los Angeles Chargers. In his last contract he received, he made sure that he was setting not himself, but his family up for success. And he incorporated this strategy into his contract, ensuring that he can build a family banking system forever. Now, so this is my wife and I, and our new little addition to the family, Mr. Wells. We live in Southern California. And over the past few years, I've met with over 3,000 families across the country teaching this wealth building strategy. And I share this with you so you guys can have some confidence in your speaker today and learn more about what we are here to teach and what we've been doing. And my story is fairly simple. I'm sure a lot of you guys actually can relate to it. When I was young in my early years, I made a lot of mistakes, as we all do. I did do one thing right. When I was 18, I actually went and served a church mission and served in the country of Georgia, of all places, over by Russia for a little bit of time and served people over there. And it was an amazing experience. But when I came home, I was in school, going to college, trying to figure out what I wanted to do with my life. And I had to make a decision. I had a lot of outside influences pushing me in different directions. In one hand, in one world, I was around traditional schooling. I was going through the traditional mindset, kind of going through life the way I'm told to do it. And then on my other hand, my other life, I felt like I was around a lot of business owners, a lot of real estate investors, a lot of entrepreneurs, and the freedom they had in their life, the control they had in their life, it definitely enticed me. But I had to make a decision where these two lifestyles were pulling me apart. And I had to decide, do I want to work in the so-called rat race and make, really work for money, or do I want to learn how to make money work for me? And it was that decision that pulled these two ideas and these two people apart, where I finally decided that I should drop out of school, leave that world, and pursue an education in investing and learning how to make money work for me. And that changed the course of my life. And above all, what's most important to me is family. I'm sure most of you guys feel very similarly. And so what I want to talk about today is how you can make more money to spend more time with your family, and how you can provide a more consistent and certain future that will allow you to have the control and peace of mind to spend more time and be with your family. And so today, what I want to talk about is some of the things that I learned going through this journey. And this first question I'm going to bring up for you guys is something that I often thought about, and it kept coming up as I was learning about different strategies and different ideas. And it was the idea of this. Could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Kind of a mouthful, kind of an interesting question, but I want you guys to sincerely stop and think about this. Could it be possible that there are more efficient environments to store wealth outside of what you're told to do? Yes, there is. There should be. I don't know if you know what that is yet, but we're going to talk about what that is today. Yes, there are more efficient environments to store wealth. And so the powerful question I want you guys to start thinking about is what you're not already thinking about, what you haven't yet been taught to think about. Guys, when we all learn about money, there's the main few books and ideas we always live by. If you read Rich Dad, Poor Dad, or you read Tony Robbins' Money Master the Game, or you read any of those, Richest Man in Babylon, those kind of books, they all teach you need to be saving money. If you can save at least 10% of your income, that's more than most people, but that's a good starting point. You need to save your income to build wealth. And in America, we actually don't. The average American saves 2 to 5% of their income every single year. That is atrocious. And a lot of reasons are equated to that. But the reason I think that Americans don't value saving is because we don't see the benefits of saving money, because the environments we're told to put that savings, they don't do anything for us. They don't grow. They seem static. And so it makes it difficult for us to want to store money in those places. Places like high yield savings, 401ks, traditional IRAs, CDs, annuities. These environments are so inefficient that it's hard for us to save money, because the money we're putting in these places, again, don't do anything. So what we're going to talk about today is banking. It's the act of banking, the function of banking that we have in our life. And every single person has that in their life, whether you understand it or you don't. So might as well try and understand it. So what is banking? What is the noun form of banking? Like the actual, business of banking. And really the definition is the business of protecting money, which I think is pretty interesting. It's the business of protecting money. So right now, if you're banking with Wells Fargo, you are choosing for them to protect your money. Interesting, right? Well, what's the actual verb form of banking? The actual act of banking? It's the act of protecting money, depositing money, and lending money. So it's the act of doing these things. Throughout this presentation, I'm going to need you guys to keep kind of an open mindset Because when you start learning about the banking world and how it actually can complement your life instead of going against you, it's going to change the way you look at money. So I keep telling you guys, we're going to build your own bank. We're going to set up a place you can do banking. You can do those three things. Well, what is that? What are those three things? And where can you do those three things? Well, if we're going to talk about what your bank is, let's compare it to a traditional bank. If we were going to build the most perfect place to store money, the perfect bank for us, what attributes would we want this bank to have? What would we want this bank to be? Well, I would want the bank to be liquid. But if you have no liquidity, you can't have access to your funds, it's no longer a bank. It's a long-term investment that kind of sucks. You need access to your funds to be able to finance things in life. What about growth? Well, the average savings account today actually averages 0.07% in growth. What if your bank was to grow at a much higher rate, 2%, 4%, 5%, 6%, 7%? What if those were the rates your account was going to grow in a traditional bank, no matter what the bond market was doing? And what if that growth was going to be uninterrupted, compounding, and guaranteed? That's a big deal. Those are big words. They all mean a lot of things, but that's a big deal. What about taxes? What if your account was going to grow tax-free? Well, your small little savings account, the tiny little bit of interest you earn, is taxed. That would be pretty cool, right? If it's tax-free. What if it was safe, protected against lawsuits, judgments, liens? You ever, in some states, bankruptcy and divorce? What if your bank was protected? And what about stability? What about any uncertain economic times? Any crashes in the markets did not affect your bank. Never went bankrupt, never went away, always actually grew. Now, wouldn't this be a much more efficient place to store money? Now, this is a place you could control, you could count on, you really could use as a foundation to finance everything throughout your life. And I get it too. Like in life, it's all over the place. We're all living chaotic lives. We're busy. Things are going on. We got family, kids, jobs, responsibilities, church, like things we got to work on and try and be our best at it all the time. So actually, worrying about money is just another thing to worry about. And again, that's actually why I don't think Americans care about saving or learning about money, because it's just another thing they need to worry about. And they got too much going on. But if this would be a place you could put money that was guaranteed to grow, liquid at all times, tax-free, risk-free, wouldn't that give you some peace of mind? Wouldn't that give you like weight lifted off your shoulders? No matter what, I know my money's safe. No matter what, I know it's going to grow a little bit. So I don't have time to find the best investments for me. I know I can just sit there and be fine. That would be nice to have. That's something I think every single person in America should be diving deeper into, trying to understand. So what actually is the bank that we're going to set up? Someone mentioned it earlier, but we call it a vehicle because it's a place your money runs through, not just the product to build your wealth, but a banking vehicle to be banking with throughout your life. And this quote I want to start by saying, before I tell you what the vehicle is, the quote is, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." So don't judge this when you first hear about it. You need to take time to understand it and learn it first. Maybe it's something you haven't heard before. Maybe it's something you have heard before. I don't know, you tell us. But what the vehicle is that we use to do banking is none other than a dividend-paying whole life insurance policy from a mutual company. Raise your hands, who thought this was going to be a presentation on life insurance? Some of you have been here before, probably know. Some of you already have your policy set up to do this. Interesting, right? I don't know if you guys thought that was going to be the concept, but it's actually a really, really strong vehicle to do banking. And I'll explain to you why. And two, this is not the regular life insurance that you're thinking of. If you were to go call your local insurance agent down the street and say, "Hey, I want life insurance to do banking," they would have no clue what you're talking about. So you definitely need to be very careful with who you set this up with, how you set it up, and what you're doing with it. And that's what we're here to do, is to teach this strategy and help people incorporate the concepts and these policies. But again, this is not a regular insurance policy. This is specially designed and engineered. This is not the whole life you hear from Dave Ramsey or Susie Orman's online. They always say it's a terrible place to put money because it's got a bad rate of return, which is totally accurate. And they're right. We don't want to use life insurance as an investment, but it's a banking vehicle. So it completely changed the conversation. So when we look at this, we want to look at the policy as a specially designed policy to do banking. And the way I kind of look at it is looking at this as a car. If you guys ever go to a car dealership and see a Ford Focus sitting in the driveway like this, you might think, well, it's a fine car, right? But maybe you're home on YouTube and you're looking up Ken Block, and if you look this guy up on YouTube, you'll see he will go 150 miles an hour drifting around a turn in this Ford Focus. What is the difference between these two cars? Design and engineering. this policy looks nothing like regular life insurance, just like this car looks nothing like the previous car, but they're the same vehicle. The policy looks like a supercharged bank account more than anything else. And remember, 2 minutes ago, I just showed you all the attributes of your bank, and we all said, yes, that would be a fantastic place to put money if I could. Where is a place that does that? Well, guess what? If you design a policy correctly, it can be that. It has all of those attributes. So, and I see in the chat, Linda, you said, well, what if you're retired? What if you're in your 50s or 60s? Awesome. This strategy will work fantastic for you to help increase retirement income, pay off debts, make other investments. 100%. Does not matter your age. We're designing these policies to do banking, not to give you a death benefit. Sure, if you were trying to get regular life insurance, the older you are, the more expensive it gets. For sure. But we're not looking to do this policy for life insurance. We're looking to do this policy for banking. So it does not matter your age. It does not matter where you live or what you do. This strategy can make sense. And when I first learned about this strategy, I thought to myself, well, whole life doesn't have those attributes. Whole life's not liquid. It doesn't have growth. It doesn't have protection. When I heard about life insurance, when I first was getting into the money space, was this. People said, it's got a low rate of return, it's expensive. And I even heard someone say it's the worst investment of all time. And maybe you're thinking similar things if you're brand new to this and you know about life insurance. And if you are looking to understand the policy, here's the number one thing you need to learn. Whoops, life insurance is not an investment. It's not. It has nothing to do with investing or investments. Whole life is considered an alternative asset class and a type of permanent life insurance. And if you read the contract, it says it's guaranteed to grow forever. The death benefit is guaranteed to stay forever. Cost of insurance is guaranteed to stay the same or decrease forever. So investments require risk. The policy has no risk. Therefore, the policy is not an investment. So all of these terms and people say about life insurance is inaccurate. It's not an investment. You can't say it has a low rate of return because it's not an investment. Again, so when you go home, talk to your neighbor, your spouse, your business partner, and they say, oh, no, don't do that thing they're talking about. Life insurance got a bad investment. Low rate of return. I can show you something better rates of return. You now know that person has no idea what they're talking about because they can't even correctly identify what type of asset that it is. So you cannot get a policy built like this from a regular insurance agent or financial advisor. It needs to be from a banking professional, which is what we are, which is what our company teaches, is this strategy. So again, listen to people who know what they're talking about. Listen to people who are actually doing this. And if we're trying to mimic banks, then let's just do what banks do. And actually, there's a book that, well, actually, let's skip this slide real quick. I think I want to show you this first. I was just saying that do what banks do, right? Well, this is what banks do. Bank-owned life insurance, BOLI, look it up. You will find that banks have more whole life insurance, not IULs, not indexed policies, not term insurance, whole life. More whole life than they own in all the real estate they own in the entire world combined. They're the number one purchasers of whole life insurance in the world. Why do you think that is? And not only do they own a lot of whole life policies, they keep buying more every single year. So you need to ask yourself, are banks stupid or do they know something you don't know, right? They know something you don't know. And these four banks alone, you all know these banks, between these four banks, there's over $60 billion in whole life. So guys, they're smarter than I am, smarter than you are. We just need to mimic what they do. So what do banks do? Well, if you were to go deposit money in a bank, let's say 100 grand, you can pick whatever number you wanted to. If it was 10 grand, $1,000, $100. If you deposited money in a bank and they were able to earn you 4% at the bank every year, like let's say you had a great high yield savings account, you're making 4% every single year. This is what the banks do. The bank takes that money and they lend it out, right? They're gonna lend it to somebody buying a house at 7%. And then when that person closes on the house, guess what? They're gonna pay the seller. And where's the seller gonna put the money? Duh, back in the bank, right? So now the bank has the money back again after that transaction, just kind of moved hands, and they're making interest off of it. And then the seller sends the money back to the bank, and the bank's gonna lend it to somebody else, maybe someone buying a car, getting a car note at 8%. And I bet you the person buying the car is gonna pay the car dealership, and where's the car dealership gonna put the money? Right back in. And then what's the bank gonna do? Lend it to somebody else, probably. Somebody on a home remodel loan at 9%, maybe, let's just say, who's gonna pay a contractor to do the work. And does a contractor have a bank? Of course they do. What about lending it one more time to somebody paying off a debt who's going to pay off some credit cards? And who are the credit card companies put the money back with? The stinking banks. The stinking banks, guys. They are in the center, controlling every single transaction, making money off of every little thing we do. Constantly, over and over and over again, making money off the same dollar. While you're making 4, they're making 7. They're making a 3% spread. While you're making 4, you're making 8. You're making a 4% spread there. Well, you're making 4, they're making 9, they're making a 5% there, 8% there. You add all of that up, all the growth they're making on your money. If you're making 4 and they're making 20% more on your 4 goes into 20 5 times. That means they're making not just 16% more than you, they're making 500% more than you are every single year. And there's actually math and reports to back this up. I'm not just saying this out of thin air. There's real math to back this up. If you guys go to BauerFinancial.com, you will read any bank's annual reports. You can find that on there from any year. And you'll see that banks make between 400 and 1300% on the money you leave there every single year. So earlier, when I told you these banks are the #1 purchasers of these whole life policies in the world, the thing I asked was, are they stupid or do they know something we don't know? Guys, they're geniuses. They know exactly what they're doing. They're banking. We just need to be the ones banking. If we can deposit money somewhere we can control, like a policy, it's still liquid so we can lend against it, so we can be financing things in our life and making interest off it at the same time. We are now the bank. So let's just be the bank. That's what we're trying to do. The next thing I want to share with you guys is the growth that I think people overlook in other investment vehicles and just in the compounding interest world, and how banks compound interest as well. So have you guys ever heard the riddle? Would you rather have $1 million today, right now, in hand, or would you rather have the sum of a penny doubled every day for 30 days? I bet you guys want the penny. What do you guys think? Yeah, it's pretty simple, right? You would think the penny would be doubled to more than $1 million, right? Well, let's see. Here's the math. Day 1, it's a penny. Day 2, it's 2. Day 3, it's 4, 8, 16, 32. After 30 days, that penny doubles to $5.3 million. That is a whole lot more than $1 million. Let's stop here for a moment and think about how powerful that money is to sit there and compound every day, right? Well, let's throw some wrenches in the plan. Let's just say you were going to double the penny every day, but that penny that doubled every day had a 2% fee attached to it every year. Now what? That penny would only double to actually 2.9 million. So that 2% of fees actually is going to cost you over $3 million, or over $2 million of compounding growth. Just poof, gone. Is 2% of 5.3 million a $2 million difference? No. So compounding effects against you are also pretty dang powerful. We don't want that. What about withdrawals? What if you had a penny that doubled every day, but you actually withdrew $100 from it on the 15th day and $100 on the 25th day, just because you needed to buy something, right? Well, that penny would actually only end up building to 2 million. So do that math. That $200 withdrawal is going to cost you over $3 million of compounding. That's pretty stupid, right? You only finished with 2 million. Sure, better than the original offering, but $3 million of loss of growth because of a stupid withdrawal? Wouldn't you have rather taken a $100 loan for 50% for 20 years? Because that you would have still had the compounding growth. The penny would have still been $5 million. So I would have rather taken a loan for $100 instead of take money out and spend it. So the point of this is to show you that the uninterrupted growth is important. If it compounds uninterrupted, no one touches it, no withdrawals, it grows pretty big. But if you take money out and withdraw from it and stop the compounding, there's a pretty big, severe negative effect. One more example is tax. If there's a 15% tax on it, you only would end up with 500 grand. That's insane to me. Only 500 grand with a 15% tax. Would have been 5.3 million. So guys, I share this simple example with you. It's kind of a bizarre scenario, right? Who's going to have a penny that doubles every day for 30 days? Like, not really the accurate scenario, but it's here to prove a point. We're told to put money in places that has all 3 of those things going against your compounding growth. Guess what the account's called? 401k. Tax is on it no matter what. It's going to be paid at some point. There's a penalty if you withdraw from it, and you can withdraw from it and stop the account from growing. And there's fees compounding against you because someone's managing the account. And guess what type of account has none of those 3 things going against you? Once it's in there, never going to get interrupted, never going to withdraw from it. No AUM fee management per year like a 401k, no taxes, a silly whole life insurance policy, guys. A whole life insurance. It's going to compound and grow every single day, uninterrupted. That way you can lend against it, finance things you need throughout your life, and be the bank. So now that we've laid the framework for you guys of the power of the policy, the credibility behind it, what banks do and how they actually operate, why you'd want to really be the bank, and now the growth, let's go put this into action. Let's give you guys a real life example of how you guys can do this. And I always start with an example of buying a car because it's just super simple. Everyone understands buying a car. Everyone needs a car. So this will make a lot of sense for you guys in terms of using a policy to buy a car, to be the bank again. So the example we're looking at here is an example of the policy itself. So I don't want you guys to dive deep into this yet. I got some things I want to share with you first before we look at these numbers. But the first thing I want to share is the premium. When you look at typical premiums for types of insurance, people look at a premium as an expense, as a bill, home insurance premium, car insurance premium, health insurance premium. It's a bill. No one likes a bill. No one wants the expense. Everyone wants the cheapest bill possible, right? Well, that's not how we look at these policies. Yes, you're paying a premium on the policy, but most of that money going into it is liquid and available for you. So if you can put money into an account that's liquid, that's called a deposit. And who doesn't want to deposit as much money as humanly possible at all times in their bank account, right? Everybody. So our goal is to now treat this policy as a place to deposit money, not an expense, and to deposit as much as we can into it, to build this account up to do more banking. And maybe you're thinking you need a lot of money to do this, right? Well, not really. I mean, start with where you're at. If you save a few $100 a month, let's start funding a policy with that. Start slowly building the account up. And maybe, I think someone mentioned too, they're retired. Like maybe you think you're too old. If I put $1 into a policy and my dad puts $1 into his policy, it's still $1, right? I still have access to $1. I still have growth on $1. So the banking of it's not different. It's just maybe my dollar gives me a bigger death benefit than my dad's dollar would because he's older than me. But we're not doing this policy for a death benefit anyways. We're doing the policy to do banking. So age does not matter. Death benefit does not really matter when we're building a policy to do banking. It's yes, it's there, and yes, there's value in that, but we're building the policy to do, again, banking. All that being said, let's give you the real life example. So this guy's scenario was he was saving 10 grand a year. He said, hey, I make about 120 grand a year. I want to save 10 grand a year, and I want to put that into my policy. I want to pay myself first. I want to put it in my bank first, all right? At 10,000 a year, the cash value in the policy is what you have access to use. That's what you have access to leverage. That's your equity in the policy, in other words. So in this scenario, he had access to 6 grand in year 1, 12 in year 2, 4 in year 3. The reason it drops in year 3 is because I want to show him taking out a $25,000 loan from the cash value to go buy the car. So you've paid 10 grand for 3 years in premium. You've now taken out 25 as a loan against your policy in the 3rd year to go buy a car. Now you go buy a car cash. You go to the car dealership, front the money, give them the check, pay off the car. Now, if you take a loan against yourself for 25 grand, shouldn't you pay yourself back what you would have paid a bank? Because now you're the bank. You want to treat yourself like you would another bank. You want to be honest with yourself, right? So you would. Let's just say your 25 grand loan you take from yourself is repaid at $500 a month. It's about 6 grand a year. And let's do 60 months, just like any typical car note. Okay. Well, if you did that, let's look at the math. Look at these numbers. Try and follow with me, guys. If you've paid 70K in total premiums over those 7 years, 30K to repay the loan you took, you've basically put up 100 grand into the policy. 100 grand you put into this. Now, you also took out 25 to go buy a car. So, I mean, your net injection into this policy is 75 G's. You've put in 75 over 7 years. And over the 7-year period, of the 75 you put in, look at the cash value. The cash value is $67,881 at 7 years. That means after 7 years, you put in 75 and you have access to 67. You have access to 91% of the money you put into this, and you have a car fully paid for in the driveway. Is that hitting? Does that make sense? Is that hitting home? You just bought a car 91 cents on the dollar, basically. Or you could say you put in 75, only have access to 67. That means you lost 7 grand. So you spent 7 grand on a car instead of 25. You got a pretty big discount for it, and you probably have a big, decent sized death benefit on this too. I don't know if this is making sense for you guys. I'm gonna show you an example of this one more time to see if this makes sense. Let's say after 7 years, you no longer wanted to pay into the policy. You're just done. After 7 years, no more premium deposits. Say I'm retired, I have no more income to save. I don't want to save more into this. Great. No more savings going to the policy. You just funded it the first 7 years. Now, let's say you take another $25,000 loan to go buy a car. If you take a $25,000 loan from yourself, you should pay yourself back $500 a month every single month like you'd pay anybody else, right? For 60 months. So now let's do the math. You've put in 0 in premiums, 30 to repay the loan. You've also taken out 25 to buy a new car. So you've put in $5,000. You have basically put in 5 extra grand into the policy. And look at how much the cash value has grown by. It grew from 67 to 91,000. Your cash value grew by $23,000 and you put in 5. So you just made 18 grand on buying a car. You put in 5 and half, 23. You made money off of buying this car. And look over the whole 12-year period. After 12 years, your cash value is 91 grand. You've put in 75 in the first 7 years and 5 grand in the next 5 years. So you've put in $80,000 and you have access to 91,000. You made 11 grand off of buying 2 cars. This makes sense? He was compounding growth on all of his principal contributions, his premiums, the whole time. And he took loans against the growth and against his policy to go buy these things, paid his loans back. And while he was doing that, his account still continued to grow. And now he's making money off of all of these transactions. So guys, there's 3 rules we incorporate when we do this. Rule 1, pay yourself first. If you save money, pay yourself first. Put that in your policy. Rule 2, if you take a loan from yourself, repay yourself. And rule 3, you want to recycle and recapture this interest, because wouldn't you rather pay yourself the interest instead of paying somebody else? Who wishes that you knew this earlier in life? Who wishes you did this last time you bought your own car? How about who's going to do this the next time you buy a car? How about the next house you buy? The next time you pay Uncle Sam? Pay for kids' college tuitions? Guys, everything you finance every single year can be done in this methodology. You can run it through a policy, make money off of it, and be the bank. Instead of getting loans from the bank and paying them interest, you're now paying yourself the interest. So all we are trying to do is take control over that banking in our life. So I'm going to give you another couple examples and a different way to look at it before we wrap up. If you, let's just say, had a $23,000 line of credit, a loan from the bank, 23 grand at 9%, you're paying, call it $300 a month or something like that. Okay. And you wanted to pay off this debt. Well, you could take a loan against your policy. When you take a loan from an insurance policy, they send the money to your bank account. So that's why we see bank accounts. So that money comes from your policy to the bank, and then you go and pay off the loan. You go pay off the line of credit that was 9%. Well, now that line of credit's paid off and you no longer have to pay $289 a month for that line of credit payment, what are you going to do with that $289 a month? Just pay yourself what you were paying somebody else. Pay yourself back that amount. So now recycle that money each month, repay yourself, and build the account back up, repay in the policy. And then as it builds back up, go do it again. Go buy the next thing, go pay off the next debt, go invest in the next investment. You're just running money through the policy in this order. So, and remember, all of these dollars you put into the policy would be continuing to grow, earn interest, and compound forever. And you're just taking a loan against it to pay off the debt and paying yourself back. And really think about that. Now, how many times are you making money on this transaction? Once in the policy, because you're growing in the money in there. And 2, if you're paying yourself $289 a month, and that was a 9% loan with the bank, you're basically paying yourself now back 9%. So you're making money 2 times in this transaction. What if this was an investment instead? What if you invested it somewhere like the Private Money Club, PMC? And you're making 12% interest every single year, and you're using that income to refill the policy. Well, with investments, guys, this just gets better and better and better. You're now making money in the investment and in the policy, and you have a death benefit, and you're protected. There's no risk. It's the ultimate banking vehicle. Now, again, I'm not here to compare a policy to your 401k, a policy to your investments, a policy to real estate. Not at all. I'm comparing your policy to a savings account and using your savings. If your whole life you save money up in a savings account and then spend it to buy something, you're back at 0. And then you save it back up and then spend it again. Your entire life, you have nothing. You are not building wealth. You're just buying stuff and spending money, giving it to other people. But if you had a system in which you could save, it grows forever, compounding forever, you're building wealth on this forever, and then you're just leveraging it, taking loans against this account to pay for stuff, paying yourself back while the account's still growing, that's how you now can build wealth off of all your savings, your debts, your purchases, your investments. That's what we're trying to do. Throughout our entire life, we are going to live and we're going to die. No matter what, it's written into everyone's life, right? It's a must. It's a guarantee. So I just proved to you and showed you mathematically you are better off with this than without this while you are alive. And sadly, we all do pass away. So when you do, your family has a massive lump sum of money sent to them when you pass because there's a death benefit included. So they're way better off with this than without. So guys, this system is not just for you. It's for your family. It's for your posterity. Don't you guys wish you knew this when you were young, when you were a young adult? Don't you wish you could teach this to your kids? Maybe you can now. Maybe they're at a point in which they'll understand this. Don't you wish you could teach this or maybe get don't you wish your parents even started the policy on you guys when you were young? Guys, our team again is here to teach this strategy. We are paid from insurance companies for the business that we bring them. So there's no cost or fees for you to do this. You're not paying us. We're not managing your money. We're not picking what you do with your funds. This is your policy you get with an insurance company you use to do banking in your own private life. We're just here to make sure you set it up right, you know how to use it, and you have a plan to incorporate the strategy. So if, for example, you did have debts you wanted to pay off, we could show you how to use a policy to pay those things off. If you were a real estate investor and wanted to know how to use your investments with your policy, we can show you how to do that. So today we've talked about how banks can profit by leveraging your money. So let's just flip that script and be the bank. And now you know you don't have to be rich to do this. Anyone can do this just with the right team and tools. And with inflation, market uncertainty, the craziness in life, family banking gives you the total control. And I should add on here, peace of mind. If you guys want control and certainty over your money throughout your life from here on out, then you absolutely need to set up a banking policy. If you do not, you are not guaranteeing your family the life they deserve. So if you want to meet and learn how you can incorporate this, go through your numbers, go through your plans, and show you how you should be doing this for your family. Again, there's no cost or fees for you to do this. Everything's literally free, right? So there's nothing holding you back. Then let's set up time to meet and let's show you how this works. Carson.beyourownbanker.com is my calendar link. If you put that link on your site, you can meet with us and learn how this works. I just sent you the calendar link to meet with me in the chat. You can see it. All right, awesome, guys. We appreciate you. See you guys next week. Have a good rest of your week. I'll see you.